Welcome to Digital Waves, here today at Tribes Amstel. Welcome, Tienko Rasker, founder of Leapfunder. You call it an angel community, but a lot of people think it's a crowdfunding platform. How do you describe it?
Well, we don't use the C word. The philosophy behind it was co-founded by a number of angel investors, classical angel investors, and the notion is that they want to standardize their contracts, because usually after a lot of negotiation and fuss, they wind up with basically the same contract for all their investment. So let's have a standard contract, and let's above all bring angel investing into the 21st century. So let's do transaction execution online, all digital, so that transaction costs go down effectively to zero, and I can do it from my sofa on a Sunday afternoon.
Yeah. So but what is the difference between having an angel community and a crowdfunding platform?
Well,
from your perspective?
The big difference is anonymity. So a traditional angel invests 100,000, 200,000 and knows the company very well and has direct impact on the management, simply because there's a relationship there. They speak. The angel goes to visit. The angel is involved in big decisions. We do the exact same chemistry. So you get to know the person, you pick them individually, whether you let them into your data room at all. The data room is full of all sorts of highly confidential stuff, so it's a very limited number of people that get admitted to a data room.
It's like classical investment, right? You need like due diligence, everything, you know.
Yeah. They do all the due diligence themselves. We just provide all the information that they would need in a central place, so that it's possible to do a traditional angel investment, including the relationship building and the contracting, with 10, 15 people. That's not normally possible. If you have 10, 15 angel investors and you go through the manual process, you send them an email with a draft contract, you get 15 opinions back. But because we standardized it and we put the data room up front, the transaction execution is easier and it's standard.
Yeah.
We don't allow seed funding because we harshly limit the maximum number of investors per round, and we harshly limit the number of people you can admit to the data room, and all admissions are one by one.
So you mean the startups and the investors? So
the investors get admitted, they apply to be admitted to the data room, and then they're selected to go in.
Yeah. So basically, once you're having a, can you call it a crowdfunding round live? Or if you have an angel round live, maybe that's a better word, an amount of funding is put into the startup. How does that work? Does the startup get that money all at once or per investment? How does it go about?
The investors just click and pay, and the cash arrives. It's held in a safe place away from the startup until enough money has been collected so that the round is meaningful. There's no point in transacting the round if there's only one investor for 5,000. There's got to be enough money there so that they can actually progress towards the next milestone. So that's minimum is predefined. When that minimum is reached, the startup can collect their cash. They simply press a button, right, and various legal processes start in the background, and about 1 to 2 weeks later they get the cash.
So let's say I'm a startup founder, I just founded my startup, I need some cash, I go to you. What kind of typical rounds are you talking about? 50,000, 100,000, 1 million?
Average I think is just over 100,000. I think it's like 115 the average at the moment. But a typical round is 15 investors for 10,000 euros each. And they start from 30 to 50,000 and they go up to 1 to 2 million.
So how do you make money? Do you charge money with the investor or do you charge money with the startup?
We charge money from the startup. We like to say we're about as expensive as a lawyer would be.
How expensive is a lawyer?
Well, I mean, if you pay the full fee for the legal work that needs to get done, if you have a small consortium of angel investors, you're very likely to pay 10, 15,000 euros. That could happen. Because you need an SPV, so a stack in the Netherlands, you need the convertible contracts, so the editing rounds and so on and so forth. So that's going to be
what's a stock? Expensive. Maybe explain very briefly.
Stock is in the Netherlands the standard way of pooling small investors so that they act as a block.
Sort of like a foundation.
Is a stichting, yes, Stichting Administratiekantoor. And that stichting has no other purpose than to own the shares legally. So there's one owner of shares, and then to split the economic benefits of that block of shares amongst a larger number of smaller investors.
And does it also mean that there are less people who have a vote into the company, that the stock acts as one spokesperson?
That's correct. So there's only one shareholder and therefore only one block vote in the cap table.
Yeah. So, but you haven't really explained how much money you make on average per startup. You said 10, 15,000. So this is cheaper. So can you name like a percentage or something that you make out of a startup?
The list price right now, the list price for the first band of 300,000 is 5.5% in the Netherlands.
Okay. Okay. Is that a lot?
No, I don't think so. A credit card is 3%. So, you know.
So you're almost as cheap as a credit card,
Yes.
or more expensive.
Well, we're almost twice as expensive as a credit card over the first 300,000. But still, that as a sort of transaction fee is not a crazy amount, given what needs to happen legally in between. We're not just bringing money from A to B like a credit card company. What's happening is that you're actually closing a fully legal angel round. So the stuff that needs to happen, a data room needs to be put together, the legal documentation needs to be in place, transaction execution needs to happen. For that entire package, 5.5% is a reasonable rate.
So it's not just getting angels fund startups online. You actually put them together offline as well. You organize roundtable sessions, all kinds of things like that. Why do you do that?
Well, we believe that the face-to-face component is and always has been, and I suspect always will be, very important in angel investing. Angel investors like to see their entrepreneur, like to meet their entrepreneur, formally and informally. Now, our concept is that rather than having all the angels go to a lot of companies, which means that they have to reserve a lot of evenings to go visit sessions,
a lot of drinks.
What we could do is we could just have a monthly regular meeting where everybody comes together in one place. And it's the neutral ground. And if people want to avoid each other, they can stand at the other side of the room. And if people want to meet, they can find each other.
Are startups a bit scared of investors, would you say?
I think they are.
Or impressed?
They are until they've met some, right? So if a startup is just raising and they have no idea what it is, angel investing, then they might get all confused. One of the good things about our regular monthly meetings is that if you have a good proposition and you can get in touch with us, you can just sign up, and within a month, essentially, we can introduce you to some real investors. And at our meetings, it's forbidden to pitch, no pitching, but you can ask for advice. We always say, if you ask for money, you'll probably only get advice. Whereas if you ask for advice, you might get some money. So
that works.
That works. So we get their mentoring sessions. You sit with one or two investors and you talk about your business problems. See if they get it. See if they can help you along. And if a good chemistry happens, then maybe afterwards during the drinks, a conversation will start about making an investment, perhaps.
I actually went to one of those roundtable sessions with the startup once, and I call them the pool of death, the group of death with the investors we had there.
Or did they burn you to the ground?
No, but they actually really gave some solid advice, but it didn't feel like they were ready to pour money in us straight away. So it feels like a little bit of, you're talking to a lot of people, but you're not really selling there yet. Is that also the kind of atmosphere that you want to radiate?
It's not a sales. It's not a pitching session. It's not about that. Actually, we don't explain it that way to startups anyway. We say to startups, this is a session where you get to make your worst mistakes in a friendly environment.
Friendly fire only.
A friendly fire, because what's going to happen is that you're going to talk to 1, 2, 3, 4 investors. They're there to help out people and get a sense for the market. You're going to learn that there's actually a gap between what you've got and what they're looking for. And that means that the conversations after that are going to be much better. So what we say to people is, look, the majority of capital in all our rounds is actually investors that you find, that we've never met before.
Okay, right.
But 60% of any round is capital that the startup finds, not us. That's been the average.
So you have to put in a lot of work yourself as a startup as well, right?
No,
I mean, it's not just lay back.
It's all about you. They're investing in you, right? All we do is transaction execution, and guidance. So what we do is we can introduce you to some real investors, and these are real investors at our events, and you can find out how they think. Yeah. And it's a spectrum. They're not the same at all, and they're different, and different instincts and different opinions and all that.
So how do they think? How does an investor think?
Depends what he's into.
But let's say a typical e-commerce investor. What are they looking for?
The decision patterns of an angel investor form over decades. through a range of professional experience that they've had.
Mm-hmm.
Either they've been very successful as entrepreneurs, or they've had other careers where they've been very successful, and so they usually have deep expertise in a few things.
Mm-hmm.
And then there's what interests them now.
So they know everything about the shit you're trying to nail.
No,
you can't just make any bullshit up, right?
They may know nothing about what you're doing, but because they
Mm.
may have had their expertise in a totally different thing, right?
Mm.
And so one of the things that makes it difficult when you're pitching to angel investors, if you line up 10 of them and you talk to them, is that no 10 of them are the same, not at all. They don't use the same decision format.
So it's very unpredictable, right?
That's correct. You really have to respond to that person. So you explain a little bit about what you do, and you start to sense the kind of questions that they're asking, and you build on that. Try and see where it takes you. And with some investors, it's never going to work, no matter what you say. And with some investors, within 30 seconds, they're in. They want to be part of it, right? We like to say that the point where you start talking about money with an investor, our corporate philosophy now is that you talk about your business, you figure out whether that investor understands your business and can contribute to it. And then when you get to the point where he understands, or he or she understands, we need money if we want to do X, that's the point where you could say, well, now that we're agreeing X needs to happen, then we need money for it.
Yeah. Where the money now?
Are you in?
Yeah.
Right? And that's, I think, is a fundamental thing. You're first engaging in a business relationship. Do you want to be part of this? And then if they want to be part of it, and you're thinking the same, then you say, okay, well, you provide the capital, I'll go do the hours. And that's how we partner.
So, up until now, what's your biggest success in the history of Leapfunder?
Well, it depends what you call success. We don't.
Well, the largest amount of funding that any startup has raised on your platform.
That's absolutely not a success for us. So
what's the biggest one?
We do not. You can look it up on our website. We do not care whether a round is big or small, because it entirely depends on what the stage that company is at. A company that's just started, that's worth something like $1 million, should only be raising 50,000 if they can. If they can, they should never be raising $500,000 because they're giving away a third of their company. And it's so we don't care whether your rounds are big or small. We don't care whether you raise them quickly or slowly. All of that is totally irrelevant. And also we've set up the economics of our company so that it's irrelevant to us actually. And so we never call that a success, and we don't treat a customer with a big round that much different from a company with a customer.
But if I were you, I would be advertising. Hey, look, startup X just raised X million amount of money. I mean, like Bolt Mobility, now Etergo with their app scooter, they raised like 1.1 million, and that was their first angel round. I mean, this is something that I would advertise, right? Why don't you do that?
No, we don't. We absolutely don't. That's not a success. I mean, it's impressive that they were able to do it
in a short amount of time as well, right?
And there's a lot of skill there in that company, so it's an important fact to note. But for us, it's not a fact worth advertising, nor anything else.
So, what is your biggest success? What do you think is your most, the startup that you like most, maybe?
Success will almost, if we ever talk about our biggest success, it will be a company where the entrepreneur and the investors did well, right? We have two customers, angels and entrepreneurs. Now,
can you name one?
If they succeed and do well, right, then it's a success.
Yeah.
Right.
You're not going to name one, right? Are you going to name one?
One company? No, I wouldn't name one company because because there are too many. I back all our companies equally, right? So there are quite a lot of companies that are really very successful. I think probably a good dozen of them now have raised good A rounds, and a lot of them have gone international. Quite a few of them actually could be cash neutral if they chose to, but they're still growing very rapidly. And there's a good couple of dozen that are worth north of 10 million.
Okay, sounds reasonable.
That's pretty reasonable, and the portfolio.
No unicorns yet, right? I mean,
no unicorns yet. Might be too early for that anyway. Maybe we'll never have unicorns, but we're 4 years old, And we say to people, expect company, given that we do pre-seed and seed, so really early stage funding.
High risk.
Very high risk, but also very long time to cash. So you're thinking 7 years. But you're thinking multiples of 60 or 70. So you have to wait 7 years, but you get a multiple of 60 or 70.
So we have to wait 3 years for the first real big exit?
We're actually realizing our first cash probably this month, but it's only a small amount. It's a small exit that's taking place in the portfolio. But it's that's our first cash from. We'll also get options in all the companies. So there's a percentage of the cash, but we also get options to invest in the company, and some of those options are generating some cash this month.
Okay, congrats.
That's one of the reasons why we don't think big rounds are more important than small rounds, is because companies.
The upside is as big as it
the upside
as it
for
gets.
us is the same. So because the options upside is the same, it doesn't depend on the size of that round.
So you just mentioned you're 4 years old. You have a bit of a history in corporate venturing, M&A. So how did you wind up in angel investing? How did you start?
Well, it started with my being a freelance M&A consultant for a while. Working mostly for Philips, where I used to work. And in that period I was offered jobs, fundraising jobs, smaller fundraising jobs for startups, which I was unable to take because I was unable to accept those jobs because the total amount is too small. And if you put your fee hour by hour against that total amount, it doesn't work economically. So the notion came about that perhaps we should have a standard contract and a standard transaction structure so that you can give some advice to the company and then all the transaction execution is just automated. So you can do the trajectory in a highly professional manner and give guidance, but without having to be there yourself all the time. And that would make it economically viable. And that's where it started. So basically from handmade transaction consulting into let's automate and standardize these transactions.
So cut out the middleman, cut out the paperwork, like any startup, right? I mean, you're a startup basically as well.
We are a startup, yes.
So a bit weird maybe, but I haven't seen any other, well, let's call it crowdfunding platform because that's a general term, but angel communities, like your other competitors, joining accelerators. So you've joined Startup Bootcamp in 2016, 2015?
No,
somewhere around that time?
2014.
Even 14 back then? So why did you join Startup Bootcamp?
Well, I had a business relationship with them already. And
your first round came from Startup Bootcamp Startup, right? That you did publicly?
No, our first round was our own. We did our own seed funding through.
Like I said, your first public one to the public audience.
Yes, that's probably right. They had a role in that. Our philosophy is that we develop our product in direct response to our customers, to the users.
The lean startup philosophy, right?
The lean startup philosophy. So the 73 investors in Leapfunder at the moment, people who've invested in Leapfunder, angels who've invested in Leapfunder, they're called the Founders Club. They actually think,
really?
Yes, and they do think
like the Breakfast Club almost.
Yes, they do think of themselves as the owners of it, the people that run it.
Oh, really?
And
do you take 73 calls a week as well about your business, or
no? But I take not 73, but so one or two of them are very active, and I speak to them on a weekly basis, and some of them I speak every quarter, every 6 months. It's very difficult to speak to them on the phone, so it's often conference calls or just an email. But they will express an opinion. They will say, "I don't like this screen. Can we make it blue? Or can we? I need an overview of that, of this, of such and so." And a feature like that will go on the list. And that's pretty much the fastest way to get anything implemented at Leapfunder. If Founders Club member shouts out, "I need this button in a different color," it's almost certainly going to be a different color unless something prevents it. So so we develop everything in response to a direct response to our investors and our startups. And so for us to have an environment to start a bootcamp where we're sitting in between the startups and the investors is an ideal environment to learn and to evolve the product. And we also were often asking ourselves, should we have some kind of strategic relationship with the Startup Bootcamp worldwide? And we couldn't figure out a strategic relationship, but then the quarter dropped, then why don't we just do it the regular way? You apply for the program, we accelerate you, and then we're shareholder and alum, and then that's it. It's just known relationship.
Yeah.
So we did it in a standard way.
But if I'm looking right now, I mean, 2 or 3 of the startups who are having live rounds are from Startup Bootcamp.
Yeah, we do a lot of Startup Bootcamp. That's right.
So yeah, maybe even half already. So it's a really close relationship, right?
Yeah, it's a close relationship. We have a close relationship with all the accelerators, to be honest, and those are always productive. And we integrate in Berlin and in the Netherlands. We integrate with their programs. We often take care of the finance training, just teaching the basics of startup finance. And that's a universal language, right? It's just shares, convertibles, debts, how does it work, shareholders
yada, yada, yada. Yeah.
The usual stuff.
Yeah.
And we
but maybe new to a lot of these startups, right? These founders, they've never heard that before. It is new,
and it's the kind of thing where if somebody just tells you the basics, then that saves a lot, right? Because if you have to find it out during a negotiation, you're usually too late, right? And you've already run into mistake number 73 before you even heard about it. So we work closely with almost all the accelerators in that way.
So looking back at Leapfunder, it's been quite a ride. Also with the entire, well, let's still call it crowdfunding niche being, still in its early stages.
We don't look at those websites or even think about them or talk about them. It's just not our
I didn't even ask the question yet, but you already felt the question coming. So how do you see your competitors like Seeders, One Planet Crowd?
No, we don't find ourselves
Eureka.
in direct competition with any of those kinds of websites.
None? I mean, not ever that there's a startup who says, yeah, I'm comparing One Planet Crowd now, Seeders, Eureka, Leapfunder. Whoever gives me the best deal, I'm going to take that one.
No, it doesn't make sense. Equity crowdfunding, where you do a giant outreach and you really reach out to the consumer, to the general public, and offer very small investments for a very large number of people, can be beneficial for a startup under circumstances. Usually, if that's
what you do as well, right?
There's very little publicity. Rounds are by admission only, by selective invitation. It's rare for there to be more than 20 or 30 people to even look at the paperwork. But so the rounds where you do hundreds or thousands of investments for small amounts can be useful for a company that's maybe got a social network of some sort, a social following of some sort. So we've had some alumni companies that have done it, right? And where we have said, and they have asked us, well, what do you think of this platform? What do you think of that platform? And we've expressed an opinion under these circumstances. What I like is this, and what I dislike is that about the platform. But are you sure you want to do it? Because of course they're shareholders, you can never get rid of them again, and you're attracting hundreds, if not thousands, of little guys that you don't know, right? So there's and you can never undo. It's very hard to unwind that position. And in some circumstances, it's good for the company to do it. In which case, we'll be behind it. But it can run in parallel, right? You can do an equity crowdfunding campaign and then 6 months later do another Leapfunder, and people do it.
Yeah, for instance, what I mentioned just now, Bolt Mobility, now eTurgo with their app scooter, they actually did rounds on Leapfunder and did rounds on Seeders, and I think then back to Leapfunder again. I mean, I think they even did one simultaneously on both platforms. So, I mean, it is possible.
For big investors, for real investors, our instruments, our financial instruments are the real deal, right? So they're complicated to use. You need to be a fairly skilled professional, skilled angel. Real investors want real shares. So you get an actual direct ownership of shares or via stack. You get voting rights. You get to negotiate the shareholders' agreement direct. You get to, and so on and so forth. You get to be part of the in the corporate structure. That's a whole different ball game, and it's a different kind of person. Much bigger tickets. Our minimum ticket's much higher, and it's a different kind of person.
5,000, 10,000?
Yeah, that could
maybe 20.
Yeah, sometimes. Sometimes it's as low as 2.5 or even 1,000, but never below.
Hmm.
And this again goes back to our founders club. The investors that built Leapfunder are angels, proper angels, and they said from the beginning, "Look, I don't want to be in a meeting with somebody who invested." That's
in
just,
gut feeling. Yeah.
First of all, the people in the meetings have to really know how the corporate structure works. Firstly, second of all, they need to be investing a significant amount, skin in the game, not a €50 or €100. I don't want to. So one of the first changes we did in response to Founders Club is to raise the minimum investment so that you get to a point where it's a real. And then the other changes is that later we limited the maximum number of investors. And we basically over time made it harder and harder to get into rounds. Perhaps paradoxically, yeah.
So if you look at the platform, actually the average size of rounds was actually smaller than it was before. Am I correct?
No, we've not had a mega deal in the last few months, which
Does that worry you?
Well, those are sporadic, right? So they're unpredictable how often they happen. But it would be nice. But the average deal is...
But you can't do sales for that, right? I mean, it's not just like, hey, you can just go door to door in every co-working space and accelerate and say, hey, yeah, do your 1 million, 2 million round with us. This is something that just drops in, right?
By and large, it just drops in, and the hardware deals tend to be bigger than the software deals. So, so hardware deals is a lot of what we're doing right now happens to be a web and app.
So go look for hardware deals, right? But they're difficult to find always, aren't they?
They're always difficult to find. A lot of hardware, certainly medical technology, is very technical. So the investors have to understand what it is. If it's so complicated that they don't understand, then it's very difficult for them to emote to it and to invest in it.
And it's not suitable for Leapfunder.
Yeah, well, I mean, you'd be limited to very technical investors who happen to understand that particular niche. There are hardware transactions where people understand it immediately, where many people understand it immediately, but that's a subsegment of hardware. A lot of hardware is a very technical sensor that's very difficult to, or medical technology that's very difficult to assess unless you're actually a deep expert in medical.
Yeah, so that's not really happening. So I've heard you talking about going to Germany, I think, already maybe 2 years ago, maybe even 3 years ago. I remember you mentioning it.
We started talking to them, started sending letters to the German regulators 4 years ago, that's right.
So right from the beginning, actually. So, and it took you at least 2-3 years, right, before you even landed. How is it going right now?
It's going well. I feel it's going well. We're doing our investor roundtables in Berlin now. They are a little smaller than Amsterdam. The market is a little out of balance in Germany in the sense that Berlin is very heavy on startups, but very light on angel investors. Right? In other parts of Germany, it's the other way around. Yeah.
What's the phrase again in Berlin?
Sexy poor.
Sexy but poor. Yeah.
So that's great. There's a lot of creativity there. There's a lot of talent there. It's very difficult. Now, investors tend to work in gangs. So there tends to be one lead investor and then there's 4 or 5 friends. So what we've right now found is that there are a number of people, gangs, where there's one member of the investor group that happens to live in Berlin. And that person we know, and he'll tip his friends. That works. But it would be nice to somehow streamline it. Either perhaps because we should do investor roundtables in the rest of Germany, so that there's a meeting point near you if you live in Frankfurt or Hamburg or Munich, wherever. We're now seeing a dynamic which surprised me a little, is that we're seeing German investors traveling in, not just to Berlin, but to Amsterdam. We have a number of German investors coming to our next investor party in Amsterdam. Because they like it, they get the energy, they get the good deal flow, and they just allocate some time in their schedule, and they travel. Yeah.
And like Amsterdam, perhaps maybe that's a good bonus as well.
Yeah, I think it's part of the fun of investing in early stage, is that you get to mix in with this crowd of young, creative, high risk.
Yeah, and get to know the ecosystem, right? I mean, it's well, not cheap, but it's a relatively incentivized way to get to know the ecosystem, I guess.
Yeah, it's cool. It gives people energy. And that's an important part of it.
So you talk to investors on a day-to-day basis.
Yes.
What the fuck is wrong with Dutch investors? Can you just explain? What's going on?
Nothing as far as I'm aware, no.
Oh. Well, if I talk to startups, they all complain. Yes. I would say bitch and moan that they're also conservative, that it takes such a long time to invest, that they're just basically busting their balls.
That will never end.
That will never end, yes. No. But is it worse in the Netherlands than anywhere else in the world? You know,
to be honest, for angel investing, it's, to my sense, is that it's not worse.
Mm-hmm.
Look, if you're talking about a private individual and his private funds, you're talking about 50,000, 100,000, 200,000, 300,000.
Yeah.
That's the kind of size that you're talking about.
Yeah.
That means that as a startup in Berlin, it's the same, and in Amsterdam, with that kind of money, you already have to get a product up and real revenue and so on and so forth. Mm-hmm. That's extreme if you compare it perhaps to some parts of the United States, where it starts with $1 million.
You could just have one line of paper, maybe 2 lines of code, and you get $2 million.
That means you get more money up front. Perhaps in the early stages of product development, you can be a little bit better, and spend more money on sales and so on. And here you have to accomplish a lot with a lot less, right? Less cash.
Mm-hmm.
I don't even know if that's good or bad for the company in the long run.
Mm-hmm. Mm-hmm.
Because I think you can usually, if you're resourceful, actually work your way around it. Maybe it'll take a little bit longer, maybe you have to do a little bit more yourself, maybe it's so forth. So I think you can get around it. Mm-hmm. That's not a fault of the angel investors, it's kind of a fault of the market and just the way it is, right? The big exits are not as big in the Netherlands as they are in the United States. So, and if the exits are smaller, then all the rounds up to that point have to be smaller. Otherwise, exactly. It's not economic. So, that's not a fault of the ecosystem. In the Netherlands, I perceive there is another, I think, bottleneck, which is hurting a lot more at the moment.
And that is?
Well, it's that bracket between 1 million and 3 million. So, what comes immediately after the angel rounds.
So, the Series A?
The mini A, the mini Series A.
I always call that a bridge round. Is that a normal phrase? I don't know. Maybe I heard it from you.
It's a normal phrase, but I don't use it for that round. The first, let's call it the A round, but it might be a small A round.
Yeah.
If it's 1 to 3 million. The A round, that we've got great VCs. We've got a lot of very successful small VCs, foreign entrepreneurs operating, and the deals that they do are very good, right? So these guys have terrific portfolios, but there aren't very many of them. And I think that's because startup has increased so much in the last 5 years that the VC market reacts slowly. An experienced VC partner will take 10, 15 years to.
So there are merely not enough VCs right now to cover all the good startups.
Not in the early stage, and you see if VCs are successful, they may want to do bigger and bigger rounds and sort of be in international companies and the B round and C round. Like the guys that are really doing the small A rounds, the $500,000 up to 2 million, we just don't have enough of them. And so, as a consequence, I see a lot of companies, Dutch companies, that have good products, have revenue, they look great, and they still can't raise that $1 million. So they wind up going back to Leapfunder and doing their 5th Leapfunder round.
Yeah.
Because eventually, once you're international and you've expanded into other markets, you may be able to get capital from Berlin, or you may be able to get capital from Munich, or something like that. But for now, it's very difficult in the Dutch market to raise that that A round.
Yeah. And maybe it will never even happen, right? I mean,
it may never even happen. Maybe even to go to cash neutral without ever doing an A round, which means that they give up a certain amount of growth.
Yeah.
So basically, they become a real business in the Netherlands, which is kind of a cool thing. Yeah. But they could have been.
But you're not a startup. You're not scaling up. You're not
scaling anymore.
Yeah. So why aren't you starting like this VC? Like a VC firm that helps these startups? Is it that hard to do it actually?
Well, it's not easy because I've never been done before in that particular model. But people have talked about it. The idea is around. Maybe something will happen. Maybe I'll have a role in it. We'll see. Keep it tuned.
Oh, so talks are in place at the moment already?
Yes, but unfortunately talks are in place, and talks can take a long time.
Okay, but your next step will probably be a VC fund of your own?
I'm committed to Leapfunder for foreseeable future. At least 5 years. But the we may still have a role in promoting such a fund that could fill that gap.
Yeah, exactly.
Supporting it and trying to get it.
So your alumni will sort of graduate into this bigger role and have they maybe have the first access to the startups or something like that.
Yeah, something like that. There could be a partnership with a fund that actually looks at the monthly updates from the Leapfunder that go to the Leapfunder investors, and therefore once they're ready to do their way around, the fund knows all about it, right, and knows exactly what the company is. Yeah. Essentially, if something is a Leapfunder company and they've done Leapfunder for 2 or 3 years and grown, then the entire dossier, you could do due diligence in literally an afternoon, because there's the monthly updates.
So once you need that 1 million, 2 million, 3 million, it's just basically push a button.
Quick, yeah. It could be real quick. That I can see would be a really step forward for the market, and I think it would never be exclusive. I think with Leapfunder, but if someone else can come along saying, "Look, here are my monthly reports," or "Here's the data," then they should be in a position to get funding.
So what's next for Leapfunder as a company? You went into Germany. What's next? UK, US, or is the European market?
We're in the final stage of regulatory clearance in Sweden and Denmark.
Okay, Nordics.
So Nordic, and so we'll have a presence in Nordic, and after that, why North? Mostly because of legal and regulatory closeness, right? So there's enough family feel, enough similarity, and because there's a very good startup scene up there, right? Stockholm School, Copenhagen School. So
a lot of fun for you as well as a founder, right? I mean,
well, I travel a lot. That pales very quickly. But my travel schedule is, I think I spend 1 or 2 days, working days a week in Amsterdam.
So whenever we see you here, it's always the same, you know? You're just hunched over behind your laptop with your earplugs in, and wearing your sweater. This is actually a really nice sweater for your. This is like your business sweater, you know. You like
clearly.
Yeah, clearly. And then you're talking loudly in the phone in English. But is that also sort of an image that you try to cultivate, or is that just you?
No, that's really how I operate. I mean, I talk on the phone for about 4 or 5 hours a day to all sorts of people, almost none of them what I do requires me to physically be in any particular location. To be honest, if I slipped out and went to Estonia for a month, then I could probably get away with it for quite a while without people even realizing it.
But never a suit, like all your corporate venturing M&A friends, perhaps.
Well, this is the funny thing, because people ask me, I can't even imagine you in a suit. But of course, I wore a suit every day for decades.
So being your own, the founder of your own startup, is that also the freedom to just do whatever the fuck you want? Is that basically it as well?
No, there's not. It's not. It doesn't deliver freedom so much. I mean, the reason I'm on the phone or an email quite so much is that there are people everywhere and wear sweaters. Is that there are people everywhere who are calling me into something where I need to be there to do something. So that's not what I call freedom, or perhaps it is freedom. It depends. I don't experience a suit as being unfree, to be honest, but perhaps a little unpractical. It's just not practical for me to wear suits. And besides, it doesn't really work because we like to sit close to the startups so that the startups can easily come up to us and connect with us. And if you go to sit in a startup place, you don't usually wear a tie. It doesn't work.
You're the corporate guy, right? They're looking at you. Who is this? Yeah. And that works. Being in a startup environment, in co-working spaces, that's the way you do your business.
That's right.
Just being there physically present.
That's correct. Okay. That's why we travel so much, right? Because we try to be physically present in the locations where the action is, at least on a regular basis.
So, final question. What will happen with Leapfunder within the next 5 to 10 years? Is there the potential to an exit? Will there be a consolidation in the market that other platforms buy you? Or would you have to go IPO? Or is this just it? Just growing market after market and becoming bigger?
Well, all of the above. We don't know, do we? There's no way of knowing.
IPO. What's your ambition?
IPO is a very specific thing, which I don't expect would happen. But the others are all those others are possible. We've developed a very unique solution for the European market, and it works very well. It could be that we're integrated into a worldwide solution. It could be that there's a financial service provider in Europe who says that we want this to be part of our portfolio. We can talk if that's someone's interested in that.
But other than that, you're in for the long run.
Well, I think if you start a business, you have to believe that it's going to be a real business, right? Our Dutch business was cash neutral last year. Not our entire business was cash neutral because we were expanding, and that's costly. But the way we look at it is that once you've stabilized the market, and we've been live in the Netherlands for 4 years, it should be cash neutral. And that's how we do our business planning. So in a sense that once the expansion is over to those regions, if we decide to call it quit, to stop there, if we decide to stop there, then we could just be a real company. But people talk about expansions beyond Nordic and Germany, and then the countries that they talk about are, to be honest, your guess would be as logical as mine at this point. But you could talk about Central Europe, you could talk about Austria, you could talk about France, you could talk about, and so on and so forth.
Singapore, yeah.
Well, I mean, in general, I think we like to stay, because we're very face-to-face and we're very much about local community, we like to stay to places that are culturally near. So it's quite possible that we'll, Barcelona would come before Singapore, I think. And it would be cool, but there's some real challenges legally in implementing a city like that.
Yeah. So to summarize, Leapfunder in 5 years would be the biggest angel community of Europe.
It already is.
It already is.
But it would be in many more countries in Europe, yes.
Okay. Tienko, thank you very much for this talk.
Okay, thank you.